Hello, fellow Rebel Capitals. Hope you're well. So the Fed comes out today and makes their big decision. What happened, you might ask? Well, they kept rates the exact same. But what was not expected is what happened in the bond market. I think that's more important. And what the Fed said in their response to not the minutes, but when Powell comes out and does this press conference after they announce that they're going to keep rates the same, this is what the market was hyper focused on. And I think this is where we got some surprise comments. And I want to go over what those comments were, what they imply about the future of interest rates, and then also give you my opinion on the Fed pausing. And as of right now, they're saying they're only going to cut twice this year, which is weird because they're saying they're worried about quote unquote stagflation. To me, none of this makes sense. But let's get into the details right now. So, first and foremost, let's go to CNBC. And right here, Fed holds key rate steady, still sees 2 more rate cuts. So on this, yields went down, as you would expect. But then yields came back up, and now I think they're positive for the day, at least the 10-year Treasury yield, which is unexpected. But that has a lot to do with the Fed's rhetoric, or at least Jerome Powell and what he was saying during his press conference. So before we get into this, let's just look at a chart here. We got the 10-year. Yeah, so see, go down and then shoots up, and now we are still positive on the day. Might roll over. I don't know if I'd be, I don't think this is a beginning of a new uptrend or anything, but it did turn the 10-year Treasury yield did turn positive. So let's go over or back to the key talking points. So the Fed has been in a range, let's call it 4.25. I think the exact Fed funds right now hovers right around 4.3, 4.33. However, the central bank expects inflation to remain elevated. So everyone on Twitter and a lot of people in the mainstream media are talking about stagflation, that, oh my gosh, the Fed is coming out and predicting stagflation. And this term I put out on Twitter is a bit like the term, well, the R word. I don't want to get in trouble with YouTube here. But and what I mean by that is when the R word is used by all those on the woke left, they use it so often and they use it to describe anything. It really doesn't have a definition. And since it's so overused, I think it almost loses all meaning. So someone can call this person the R word, and it doesn't have the same meaning at all as it. In fact, it's almost, now it's almost a compliment because, someone that could be a champion of freedom, as an example, could be called the R word. And so because it's just lost all meaning, I think the word stagflation is very similar in economic terms, where it's been so overused and it's being used so inappropriately that now when you say, oh, we're worried about stagflation, it's lost all meaning. So the Fed right now is saying that they're worried about the economy slowing down and a reacceleration of consumer prices. And therefore, that's why they're pausing. That's what the rationale they're giving. And that's why you see the yields tick up there after Fed started to speak. But if you just think this through, just even a little bit, it doesn't make sense at all. First and foremost, we were supposed to have seen this big spike in inflation due to the tariffs. And have we seen that yet? No. We still see disinflationary trends. Not to mention the fact, even if we do see a spike in inflation, or at least the headline numbers, as a result of the tariffs or something like oil, that's going to be a price adjustment. It's not necessarily going to lead to a reacceleration. And when you talk about stagflation, this is what really the definition is. It's extremely high inflation. It's extremely high unemployment. And then it's a contracting economy. Okay, well, we don't have, think about this for a moment. Let's go back to the Market Watch calendar that we've been referencing lately. And I want to go back to last week when we had the CPI numbers. And here you go. So month over month, we're at 0.1. Year over year, 2.4. And core was 0.1. Expected was 0.3. Core CPI year over year is 2.8. So let's just say the Fed's target is 2%. Now, I know that this understates inflation. But what we're doing right now is we're looking at the trends and we're looking at it through the lens of the Fed. And the Fed, whether we like it or not, whether we think it's wrong or correct, inaccurate, whatever, they look at these metrics and assume they're written in stone. Like if the CPI says it's 2.4%, then darn it, it's 2.4%. So that's what I'm talking about right now. So I don't understand how the Fed can sit there and say, all right, well, if it's 2.4%, then inflation is so high, it's running so hot that we would categorize this as stagflation. But yet, if the CPI is 2%, 0.4 lower, then oh my gosh, this is perfect. This is the ultimate economy. This is economic nirvana. And then yet at 1.9%, oh my gosh, holy cow. Now we've really got things to worry about because we're going to have this wave of deflation. And oh my gosh, we can't have that. So we've got to do anything possible to get the inflation rate back up above 2%. But yet that's a 50 basis point difference. It's a 50 basis point spread at the end of the day. And we somehow go from massive concerns over deflation to massive concerns over inflation to the point where we're labeling it stagflation. And it's a 50 basis point delta. Like, what are we talking about here? So you could say, well, the Fed expects inflation to go up to 3%. Okay, fine. So it does. It goes up. That's a price adjustment. That's not a reacceleration of consumer prices. There's a big, big difference. And the reason I always pound the table on this is because people look at the tariffs as a tax. Okay, it's a tax. I completely agree. They say, well, this has to increase prices. Well, maybe some, absolutely. But that means it can lower prices elsewhere in the economy because you're taking demand from over here and allocating it to these things that you have to have with higher prices. Robbing Peter to pay Paul. We say on this channel all the time. And it's the same thing with oil. Now, what I'm going to do here in a moment is I'm going to go over a chart of oil during the GFC. And I think you guys are going to find this fascinating because this is the last time that we really had one of these big rate cutting cycles, outside of the cerveza sickness, where the Fed was really worried and the mainstream media was really worried about quote unquote stagflation. And if you don't believe me, go back and read the Wall Street Journal, the archives, especially during the summer of 2008. It was all about stagflation, a reacceleration of inflation. The Fed is offsides, and the Fed needs to start hiking rates. This was in the middle of 2008, mind you. But I don't want to let the cat out of the bag here. We'll get into that in just a moment. So let's go back to what the Fed was saying today. Open Market Committee sees 2 more rate hikes. Look, if you're worried about stagflation, which I don't think you should be, and I'll go into that even more in a moment here. But if you are worried about stagflation, why are you dropping rates at all? Like, why does the dot plot suggest 2 more rate hikes? Why not no rate hikes? I don't get it. Like, why would you even signal that you're going to drop rates if right now you're caught in the middle of, oh my gosh, the economy is slowing, but oh my gosh, we're going to have a reacceleration of inflation? It sounds to me like you just wouldn't do anything, and you would tell people that until further notice, we're not doing anything. That would be represented in the dot plot. You see how any way you look at this, it makes no sense. It just doesn't add up what they're saying. Even if you're someone that buys into the stagflation narrative, or you're someone that believes the complete opposite. Okay, they go into the dot plot, blah, 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 blah. Like that predicts anything. GDP forecasts have come down. Yes, they have. Trump pushes for rate cuts. And this is something I completely agree with him. Now, I don't think the rate cuts will really do much for the economy because I don't think interest rates control the economy. I think interest rates are a representation or a reflection of what is happening in the economy. And let's remember that a large part of the curve is still inverted. So even if the Fed drops 25, I don't know that that would even impact the long end. It might not even impact anything outside of 6 months. It might just impact the very, very front of the curve. And then you have to ask yourself, okay, what does that do for the economy? I don't know, probably not much. But if we're looking at this just through the lens of what the Fed sees in their framework, which is what I want to do here, I can see why Trump would say you got to cut rates. I mean, Trump is doing this because he thinks just whoever has the lowest rates, they win, right? Like the ECB has 2%, so we have to be at 1.75 because 1.75 is obviously better than 2%. I think that's the extent of his economic knowledge, let's say. But I would agree with him. I completely disagree with him on a lot of things. I think what he's doing with Iran is bananas, but we'll save that topic for another video. And obviously, from an economic standpoint, I don't like tariffs, although I think they're a good negotiating tactic. But here, if I'm just looking at it through the lens of Jerome Powell, I agree with Trump. Like, dude, why are you not cutting rates? So now what I want to do, and I know I'm bouncing all around here, but we've got to go over all this data so we can kind of connect the dots. Let's go back, and I want to remind everyone what's happening with the overall data. Now, I'm not saying that right now we're in a recession, and who knows if the NBER ever comes out and announces it anyway. But we all agree that the economy is not running on all 8 cylinders. This strong and resilient nonsense is for the birds. I think it's just for people that have their head buried in the sand. So I would call it like a stuck in the mud economy that's kind of teetering on the edge of recession. It's not great, but it's not just completely catastrophic. I think a large majority of Americans are in a recession. We know the airlines, they have come right out and said they're in recession. It looks like a lot of the restaurants are going into their version of a recession, but we don't have negative economic real GDP yet. And we don't have the unemployment rate spiking, although we need to get into the details of that as well as far as the labor market. But you have to admit the labor market is slowing down. And in the past, when we look at consumer price inflation, just show me a time in U.S. history where you have the labor market softening dramatically. And you have the economy slowing to the point where recession, economic contraction, and you actually see inflation going up as measured by the CPI. It's not a thing. It doesn't happen. It doesn't happen. So you can't have both. What I mean by that is, can you have high unemployment and high inflation? Yes, obviously you can. Look at the 1970s. But even in the 1970s, when you have the unemployment rate spike and you have an economic contraction, recession, you have the inflation rate going down. Now, it's going down to a high level, but it's still going down. So if right now our starting point is, let's just say 2.4%, and it goes up to 3, okay, fine. At the end of the cycle, if history is a teacher, in the 1970s, it'll be lower than where it started, which is 2.4. And I don't know if it's lower than 2.4. Now we're getting into the 2% zone, maybe the 1.8, the 1.9, where all of a sudden it's way, way, way too low, where we have to start worrying about deflation. So it's just like, I mean, the difference in the Fed's eyes between stagflation and deflation is like this thin to the point it's just ridiculous. It's absolutely ridiculous. But let's go over what I think is kind of the key here. And I just can't get my head around the fact that the Fed isn't acknowledging this. I mean, we go over to, I was reading some of the things that Powell said. And, oh, here we go. So we can go over here and check this out before I get into the labor market stuff. But he's saying no signs of the economy weakening. No signs at all. And then he was referencing how great the labor market is because we have 4.2% unemployment. Let's pause for a moment and go over to the last unemployment release or report from the Bureau of Labor Statistics right here. Everyone focuses on the headline number. Now, the headline beat slightly, but it was still extremely low, extremely low. And then when you look at the household survey, because that's what goes into the calculation for the unemployment rate, we can see this number. And very few people were talking about this because it just kind of gets swept under the rug. Because all we want to know about is the non-farm payroll, the establishment survey, and then, what's happening with the components that go into the unemployment rate. Well, who cares? We don't want to know about that. All we need to know about is non-farm payroll and 4.2% unemployment. But look at this. Shouldn't we more so be worried about how many jobs were created or how many jobs were destroyed over the past month? Isn't that more important, especially when you're trying to measure aggregate demand in an economy that's 70% consumption? I mean, this is childlike stuff. This is the basics here. This is just critical thinking 101. And right here, I want to point, and I don't know if any of you have even heard this, but the very last report we have, and I'm staring right at it here, when we look at the total employed, right here, we go over, and from April to May, 1 month, the United States economy lost almost 700,000 jobs. That's right. 700,000 jobs lost. Gondo. Poof. So you say to yourself, well, how on earth is Jerome Powell coming out and saying that the labor market is strong and resilient because 4.2? Because what happened is we had massive job losses, but we had massive decrease in the labor force. So you can see here, the labor force decreased by 625,000. So this almost completely offset the 696,000 job losses. So you still have roughly a 4.2%, they're kind of rounding there, but you still have roughly a 4.2% unemployment rate. So the unemployment rate looks great, but on net, we're losing jobs. So think about how insane this is. We could have a 4.2% unemployment rate, yet we could have 10 people working in an economy of 350 million if the labor force participation was low enough. And are you going to tell me that's a strong economy? That's resilient because unemployment's only at 4.2%? I mean, what are you talking about? This is insanity, right? Let's just assume what would that be? So assume we have 100 people in the labor force, the way they measure it, in an economy of 350 million people, and 4 of those people are unemployed. You're like, whoop, nope, nothing to see here. Labor market strong and going on, strong and resilient. The labor market is on fire. Wow, this labor market, I tell you what, you can't beat it. I mean, an economy of 350 million people with 96 people actually having jobs and working, that sounds extremely solid to me. This is the nonsense. All that the mainstream media does is they just simply focus on these headline numbers, and they don't take 30 seconds to just sit there and think about it. And what's crazy is if anyone should be opening our eyes to the nuance and the detail of these headline numbers, it should be Jerome Powell himself. But yet he's just parroting this nonsense, this drivel that we're hearing in the mainstream media or on social media for the most part. I'm not done yet. Let's go ahead and look at, I want to focus. Well, we'll move on from the labor market because I could go to the ADP numbers. I could go into the fact that the non-farm payrolls were extremely low, although they're above expectations. I can go into the restaurant index, how that's contracting. I think that's a big, big indicator of the average Joe and Jane and how they see the economy and how they are seeing their own purchasing power, right? I think that's really the first thing to go when when normal Americans are tightening the belt because they're concerned. But let's keep moving on. I want to, let's see, go M2 money supply right here. I use this in today's whiteboard video. Now, I know that we had a big increase right here in between 2020 and 2022. We all know that, right? But since that time, M2 is down. M2 is down. So you don't have a huge increase in M2 and then the inflation show up 10 years later. That's not the way these things work. Again, we can just go back to the 1970s, which I'm going to do in a moment, and pull up a chart of M2 and pull up a chart of the CPI. And you can see that there's a slight lag, but it's not 3 years. It's not 5 years. So the reason, or one of the main reasons we had disinflation since the summer of 2022 is because we haven't seen, in fact, we saw a decline initially of M2. And if you have oil prices going up, if you have tariffs going up, yes, that increased the price of some stuff, but you're taking demand away from something else. And that's why we're seeing demand plummet at restaurants. We're seeing demand plummet at things like airlines. And this is discretionary spending, right? Because this, why I'm bringing up M2, is because it's pretty much a reflection of what's happening with nominal wages. And if you don't have nominal wages going up to the same degree as the tariff or as the oil price or whatever, you're just, at some point, the consumer waves the white flag. It's, I'm tapped out. I can't buy anything. And then all those companies have to lay off their workers. Unemployment rate goes up. Aggregate demand overall goes down. And then you see the price of oil crash because although supply may be constricted, demand is falling at a faster rate. So it's almost like the high price of the tax or the high price of the oil, because it's not really at a high price because of things that are happening in the real economy. This is the catalyst to going from a stuck in the mud economy to an outright recession or contraction, where if you combine that with a spike in unemployment or even a huge job losses, I mean, forget the unemployment rate, just focus on the job losses, then this is what usually or often leads to something that the NBER would even come out and say is recession, which is not inflationary. That is disinflationary. I'm not saying deflation. I'm not saying prices are going down. I'm not saying prices are going back to where they were in 2019. That's never going to happen. I can assure. Now, asset prices may go down, but I'm talking about the stuff that you're buying daily. That is never going back to 2019 levels. So I'm talking about disinflation. I'm talking about prices are still increasing, but they're increasing at a slower pace. And they're definitely not increasing at a rate which would qualify as stagflation if you're using the 1970s as a model. So now let's go over to, I want to focus on the GFC. Well, I think I've explained it on these videos plenty of times, how in the 1970s, you just pull up a chart, in the 1970s, you see the CPI go up, and then you see the recession, the spike in unemployment. Then after that, you see the CPI going down. In other words, disinflation. So just look it up. I mean, or just look up the recessions, the economic contractions that we had, even in the 1970s. And at the end of the cycle, inflation was lower than it was at the beginning. So again, if our starting point right now is 2.4, 2.5, even if it's 3%, for heaven's sakes, if that's your starting point, then we get to the end of the cycle. Even in the 1970s, we would be lower than 3% and getting close to 2%, the Fed's target, or maybe even less. And I don't know if it's less than its target, how you could qualify, or that would be put into the bucket of stagflation. I think you guys understand my view there. Now let's move on to oil prices here, because we know that oil prices going up because of what's happening, the unfortunate, very, very unfortunate, what's happening in the Middle East here. But from an economic standpoint, it is what it is. So let's look at another time in U.S. history when we had a weak economy, when the NBER had not come out and stated that we were in a recession, and there was a lot of debate around that, just like there is right now. And that time frame would be the end of 2007 into 2008. So you guys know from watching my videos, the Fed started cutting in September of 2007, same date, September 18th. They cut by 50. And then they went on to cut another 225s, 100 basis points, the exact same as we saw in 2024. What's different is they continued to cut into 2008, where this Fed obviously paused. So one of the reasons why everyone was just losing their minds in the mainstream media back during the GFC, and of course they didn't know it was the GFC during the first part of 2008, was because these oil prices were skyrocketing. Look at this. We go from 79 bucks, call it, all the way up to, and that was when the Fed started cutting rates, to the middle of the summer of 2008, and we're at 133. 133. Now, it is true that if we go to our chart of inflation during this time frame, which is represented by this red line, guys, we can see the CPI tick up. It goes from roughly 3 point, I wish I could get it. This is kind of fickle here, but starting, you can't really see. Okay. Take my word on it. Starting in September of 2007, we're basically around 3.5, and we go up to 5.6. Now, the Fed was cutting. Would you argue that during the beginning of 2008, even though the CPI was going up slightly, that the Fed should have been paused or should have been raising rates? Or do you think it was appropriate, hindsight 2020, that they actually cut rate? Oh, of course, cut rates, because no more than a few months later, we go from 5.6 on the CPI all the way down to zero. And mind you, what got inflation down? Was it the Fed increasing interest rates? No, it had nothing to do with that. It had to do with the fact that we had a weak economy. Oil goes up, takes demand away from the other components of the economy. Unemployment rate spikes. Non-farm payrolls go steeply negative. And then this triggers what we now know as or is one of the things that triggered what we now know as the GFC. So I'm not saying that without high oil prices that we never would have had a recession. Yes, we likely still would have had one, but the higher oil prices, I think, were one of the things that that pushed it over the edge and exacerbated the problem, and therefore exacerbated the financial crisis that we had within the banking system, the monetary system, and you guys know the rest of the story. So it's again, the point I'm trying to make here is, although you may have short-term inflation due to higher oil prices, in this case, 130 bucks a barrel, this, when you combine that with the weak economy where wages aren't going up, this usually leads to a recession and disinflation, ironically, not an acceleration or a further acceleration of consumer prices. And I'm not saying that we're, GFC levels right now, or that the banking system is going to blow up, but I am saying that we could see this increase in the price of oil at a time when the economy is very, very weak. So although this might not be a direct analogy, you've got to at least consider it in your analysis. Here's the ISM services. I just wanted to touch on this briefly too. We just had a print below 50. And although this isn't always a recession, when you see when it goes below 50, it's not a good sign, for heaven's sakes. This is a sign that the economy is extremely, extremely weak. So again, I don't know what Jerome Powell is talking about. If I'm looking at this through the eyes of the Fed, I don't see an argument. I don't see a valid argument for them pausing, not dropping rates, even if you want to use oil. Still looking at 2008, we saw how that one panned out, And then let's look at the Fed funds rate. I think you guys will get a kick out of this. If you didn't take anything away from today's video, I think, or if you're going to take one thing away from today's video, I think this should be it. So I want to start by going back to 85 roughly. Why am I just going back to 85? Because most people don't know this, but prior to Greenspan, the Fed really didn't target interest rates. This is not what they did. Prior to Volcker, they targeted like kind of like a range, but it was very wide, extremely wide. In fact, I think with Volcker, his range was like 4%. That's what his range was, not his target rate. And they kind of micromanage bank reserves, like, you know, as if that did anything. And then Volcker came out, and his whole point was not to increase interest rates; it was simply to slow the money supply. So what he was doing is he was trying to manipulate the amount of bank reserves to slow the money supply to create a recession or to break the back of inflation, if you want to use that phrase. But it wasn't really targeting interest rates. So Greenspan, first person to do that. And that's why when you look at the Fed funds rate prior to Greenspan, it's just got this wild volatility, where after Greenspan, it's pretty stable. You know, at least the direction, you don't see all these up and down. It doesn't look like a heartbeat. So that's why I want to focus now on Greenspan and when the Fed actually started targeting rates. So call it the modern Fed. And we go back to 89, almost 10% on the Fed funds rate. Then we see this big drop down. Okay, now you'll notice a pattern. When the Fed does a big rate cutting cycle, or they start a rate cutting cycle, you almost always have a recession that follows. Now, there's an exception right here where they drop rates slightly, but you didn't have the whole entire curve inverted like we've seen it over the past 2 or 3 years. Not it's still inverted to a certain extent, but not to the extreme that we saw earlier. And then same thing here. You know, you didn't see the big decline in or the big rise in unemployment, the big decline in labor market. You didn't see these things. So did the Fed prevent a recession right here, or was there no recession to fear? I would argue it was the latter. But my point is, just show me a time in the modern day Fed where they cut rates too late, where they cut rates, and now we look back on that and say, oh my gosh, whew, that was a big mistake. They cut rates, and look, inflation accelerated. Inflation went up, and they had to backpedal and increase rates after they cut them. Show me that time. It's a rhetorical question. It doesn't exist. The Fed has never, ever been too late. Now, have they been too early? Well, I don't know. You can sit here, or excuse me, the Fed has never been too early. I think I said that the wrong way. The Fed has never been too early if you're looking at Fed funds versus the CPI. Then you say, is the Fed ever been too late? Here, I think there's a strong argument that they've been too late because they cut rates. And other than this period right here in 1995, which I think is apples to oranges, when you do an apples to apples comparison, considering all interest rates, the yield curve, derivatives, unemployment, all these other things, you see that they're never too early and they're always too late. And if you want some backup, just simply look at the 2-year Treasury. Because when you look at the 2-year Treasury relative to Fed funds, let's just go ahead and pull it up here, you see that the 2-year Treasury always leads. Here we go. Let's zoom out. And let's just start this, keep it consistent here. We'll start at 85. So Fed funds red, 2-year Treasury blue. And keep in mind, the 2-year Treasury leads to the upside as well as the downside. And I don't think this is just a reflection of or the market trying to anticipate where the Fed's going to go. I think it's the market anticipating where the Fed should go based on the underlying fundamentals of the economy. So the Fed has never cut too early. Never. And they've almost always cut too late. And they've almost always increased interest rates too late. So why on earth should we look at this right now and expect that somehow this time it's going to be different, where if they continue to cut, then, oh my gosh, it's going to let the inflation genie out of the bottle, and then we're going to go back to the CPI going to 4, 5, 6, 7, 8, 9%. It's just it's so unlikely. The odds are so outweighed on the side of the labor market getting worse and an economic contraction versus runaway inflation or inflation accelerating, that it just takes you back to that original point I was making. Why on earth would the Fed not drop rates here? And if they are worried about stagflation, why is the dot plot showing that they're going to decrease rates a couple times this year? Why not just say that you're not going to do anything to rates until you see one thing break or the other? It's a completely incoherent message, I think, is what I'm trying to say here. Regardless of what your opinion is on inflation or what your opinion is on the economy, it's still completely incoherent. And I think that you have to just be the ultimate Fed like patsy or the ultimate Fed sympathizer or brown noser like Steve Leisman or something like that, to sit there and listen to what they're saying and say, oh yeah, that makes sense. Oh yeah, absolutely. I do the exact same thing. My base case is when we look back on this, it's going to be the exact same thing that we've seen over and over and over again, where we're just asking ourselves, why did the Fed not act sooner? Why were they so far behind the curve? They're behind the curve when inflation is going up. I think they're going to be behind the curve on the opposite side, like they've been all the way back to when they first started targeting interest rates. Let's go back over to markets here. I just want to see what they're doing. I know they could have a lot of volatility as the Fed talks. Okay, the Dow down 50 or so. Now we've rolled over on the 10-year. That's actually not too surprising. Bitcoin, this is weird. I said yesterday in the video that it seems like you've just got a ceiling at 106 or 107 on Bitcoin, and some whales come in and just start selling. I'm sure this is just a short-term phenomenon, but it's just wild to see that price, that price action so consistent. Gold down slightly, and then oil, hovering around 75. So I don't know that there's a great there is a concern for sure. I don't know what the odds are that oil goes up 100, 120 like we saw during the GFC. Probably low, hopefully very low, because that means that we're not getting a further escalation with the Middle East. But I don't know that just oil going from 60 or 65 up to 75 would be a big catalyst to take the economy from stuck in the mud over into what the NBER would define as a recession. But it's something to calculate. It's something to include in the analysis for sure. All right, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market capitalism, and we'll see you in the next video.